Good afternoon, everyone. My name is Ibrahim Alawat, and on behalf of Al Jazeera Capital, it is my pleasure to welcome you all today to Jamjoom Pharma's earnings call for 2024 results. With us today, I am pleased to welcome on the call our panelists from Jamjoom Pharma, Chief Executive Officer Mr. Tariq Husni, Chief Financial Officer Mr. Anwar Muhiddin, and Associate Director of Finance and Head of HR Mr. Muhammad bin Khalid. The format of this call will begin with a presentation from management before opening up the floor to participants for a Q&A session. So without further ado, I am yielding the floor over to IR Director Mr. Muhammad bin Khalid. Mr. Muhammad, the floor is yours.
Thank you, Ibrahim, and thank you, ladies and gentlemen, for joining us for our 2024 earnings call. I'm Muhammad bin Khalid, the Head of Investor Relations, and we're pleased to present to you a 20-minute presentation from the CEO and CFO, after which we will open the floor for questions for the rest of the call. Over to you, Dr. Tariq.
Thank you, MBK. Assalamu alaikum, everyone. Bismillahir Rahmanir Rahim. I welcome you all to our earnings call for Q4 2024, as well as the full 2024 financial audited data for Jamjoom Pharma, in addition to the guidance of 2025. Just as a memory refresher, you will all remember that I joined the company in end of April 2021. We took the following 8 months until the end of 21 to normalize the post-COVID era, and then we embarked on our first business cycle. I always look at business cycles in 3 years lots. So that was like our first business cycle together as a team between 22 and 24, and I'm glad to report to you that we couldn't have ended up this first cycle in a better shape. I'm also glad to report that I stand here ahead of you much more confident about the future prospects of Jamjoom Pharma and the business that we embark on, and we are continuing to drive and will continue to drive across. So without any further ado, let me just start by giving you some highlights on our financials for the full 2024 years. So in revenue perspective, we managed to conclude the year at 1,318 Saudi riyal, which is in excess of $350 million, which is a 20% year-on-year growth compared to how we closed 2023. It's almost as well a CAGR of 20% within the business cycle that I just mentioned to you. So 20% almost year-on-year growth between 22 and 24. When we speak about our EBITDA margin, a record EBITDA achievement of 437 million Saudi riyal, which is 27% growth year-on-year, and a margin of 33.2%. Again, definitely a mix of looking at both efficiencies and effectiveness, driving efficiencies through cost optimization and driving effectiveness through selling more of profitable and high margin products and lucrative business as opposed to dilutive business. And we are becoming smarter in doing this over and over again as the years go. Excuse me. From a net profit perspective, we managed to close the year at 357 million Saudi riyal. You will see later, as I'm going to present to you, that if we didn't take certain legitimate provisions, this number would have been almost close to 370 million. But we've done the right thing, and I'm going to share with you some of the provisions that we have taken as well. So basically, again, growth of 22% year-on-year on the net profit margin, and it stands at 27% of the top line. If we didn't take the provisions I told you, it would have been close to 29% almost. Managed to launch 9 products across, which is something I'm I take positively. It's across our key businesses and sectors and therapy areas. So 4 products in consumer health, 2 products as type 2 anti-diabetic oral treatments, 1 in ophthalmic, 1 in general medicine, and 1 in the. Very pleased about the diversity of the products that we launched. And as a refresher, again, I remind you that we took a commitment on ourselves that we launch every year between 6 to 10 high quality launches. And speed to market is the name of the game for us within this kind of launches. Our free cash converts stood at an excess of 100 million US dollar or 380 million Saudi Riyal, and very healthy cash balance that we stand at, while we kept the capex at the lowest part of the guidance. We always said capex will be at 4 to 6%, and we finished the year at 4%. And we keep on scaling up, obviously, our operations and our production across our key facilities so that we can meet and exceed the increasing demand that our commercial troops are generating day in, day out. Moving to next slide. Yeah, so just a quick recap on 24. Basically, if I look at the Saudi market, very pleased with the achievements. While the overall market grew at 11%, if we take the weight loss products that we always spoke about off the table. And we definitely, as a Jamjoom Pharma, grew at a higher rate than this. We achieved a 7th rank in the total market, including both institutional as well as retail sectors. And this is coming, just to remind you, from a position of number 12 in 2020. So over 4 years, we gained 5 ranks within the total Saudi market. Achieved the 3rd rank, which is the same position we had at the end of 2023 in the Saudi retail market. And our tender business grew even at a higher pace than our retail business. If I look at export markets, Iraq, Gulf, Egypt, every market continue really, and I'm going to show you a separate slide on this. We drove growth across all categories and all key markets. From a portfolio point of view, I'm very pleased with how we are progressing on the cardiometabolic therapy area front, and I'm going to share with you as well how we are becoming more innovative in even approaching this therapy area from a management and leadership.
Mr. Tariq, I believe there was a disruption in the sound. We cannot hear you at the moment. We still cannot hear you, and apologies, ladies and gentlemen.
We are addressing the issue. Let's see.
All right.
So apologies, guys. I just got to know that I was talking to myself. Apparently, my voice got lost for a few seconds. So basically, I was talking about cardiometabolic, and I'm going to share with you how we are progressing in trying to be innovative. Manufacturing. Jeddah facility, it's almost operating at 100% in 24, but we started to relieve a lot of the volume that will go to Egypt, and that hopefully will enable us to perhaps utilize this volume saved from Egypt into other markets. Then produced almost 3.5 million in 24, and Egypt continued to scale up. Basically, almost 70% of the requirement of the market, the local market was provided through the facilities there. Excuse me. When I speak about our BD initiatives, I think this is something that you will hear more about as we move on. So we are exploring, as I spoke to you earlier, bringing some footprint for Jamjoom Pharma in places like biosimilars, biologicals, and other opportunity in this regard. But until we really finalize something meaningful here, I'm going to share with you our progress in this regard. And then something very important, which is how can we tailor some business development efforts and activities to enable us to really scale up our presence and our footprint in places like Gulf, Egypt, North Africa, through sometimes buying market shares and ensuring that we really become a key significant player sooner than later. Moving into next slide. End of 2024, we did a vision and a strategy refresh exercise. So I'm sharing it with you today, guys, firsthand. So on the vision front, we didn't change much except in a couple of perhaps words. So in the initial vision, we said to become the leading MEA organization compared to 3 years ago, it was a leading, so the A changed into the, and perhaps because of our confidence today that we are really becoming the leading MEA organization and one of the best performing across the Middle East and the North Africa markets. And definitely we are going to consistently do this by serving our communities well and providing affordable, high quality healthcare solutions. And we split our strategy into 3 areas in terms of focus. Start with portfolio, moving into market focus, and moving into serving our people and community. So from a portfolio focus point of view, definitely our flagship, which is the ophthalmology and dermatology products, we will like to continue to strengthen our leadership there and continue to be really the known player in niche therapy area. From a specialty and cardiometabolic point of view, we set ourselves a target that in over the coming 5 years, we become one of the top players in this category, and we really continue to offer meaningful solutions and services in this highly demanded area, as well highly competitive. From a biologicals and biosimilar point of view, we definitely would like to embark into penetrating this category and bringing some unique solutions in this regard. And then definitely we are very pleased with how we have taken our consumer health portfolio over the last 3 years from almost a very insignificant player into today the number 1 or number 2 player in the consumer health in our key inception market, Saudi Arabia. And we would like to continue to grow this business, especially with the observation we are witnessing across the region, whereby our consumers and users across the region are becoming more empowered and taking their health into their own hand and becoming more proactive into looking at preventive ways of stopping diseases before happening. And this is where we can really dial in with our consumer high quality products. From a market focus point of view, definitely the Saudi Arabian market will continue to be a key market for us. And in this regard, we would like to continue to drive the institutional and tender business cognitively and in a profitable manner without diluting our margins. Continue to assertively grow retail and introduce new products with launch excellence so that we can really continue to win in this regard. Gulf, definitely we are catching up in this very important market for us as well, which supposedly should be our second biggest market. So we definitely would like between Gulf, Egypt and North Africa to perhaps design through our business development troops some tailored business development activity to enable us to hit the ground running and to jump before we walk in these very important markets for us. So basically, how can we have tailored business development or targeted business development activities for each of these markets? In Iraq, definitely we are very proud of our leadership into the ophthalmology and dermatology lines there, and we would like to even further consolidate and expand our leadership by launching cardio-metabolic products and some other key products that we have in Saudi and is not yet in the Iraqi market, so that we can definitely drive our leadership forward. From a people and community point of view, we definitely would like to continue to evolve our structure and acquire and develop talent. And I'm going to share with you an illustrative slide about how we are walking the talk in this regard later on. Then empowering and transform our learning and development across the organization and be really a very continuously learning organization which can drive our continuous growth and development as well. Then definitely driving a culture driven by performance and attitude, whereby people are judged mainly with how they perform and as well what they deliver and how they deliver it. So very important, and we continue to drive this culture as we move on in our maturity as an organization. And then definitely last but not the least important is our sustainability initiatives, and this is how we modestly try to pay back the community that we serve and that serves us as well in our business by definitely doing all the right things from the green environment and contributing to definitely bringing some smart factory initiatives where we reduce carbon emission and do a lot of important things that can enable us to modestly contribute to the vision of the country. This is a slide that I think you guys are getting used to. I'm just updating you here that in our main facility in Jeddah this year, as I told you, last year we almost approached 150 million. This year with all the numbers we have, we believe that we will need in this facility to produce about 145, 146. So that's a bit relieving with the facility this year, unless obviously that as the year moves on, as always, we find increasing demand and our troops are releasing more and more and stimulating more and more prescriptions. So hopefully, if this happens, we can meet it as well through the reserve demand in this or capacity in this facility. In the sterile facility in Jeddah, as I said, it's a 25 million capacity facility for sterile products and injectables. Almost only 10% capacity is utilized today. I believe we are going to close the year something close to 25 to 30% capacity utilization there. Cairo, as I told you, it's almost at 50% capacity utilization today, and we believe that we will move into 70% before the end of the year. And we continue to evolve our Algerian facility. It's at the moment mainly focusing on the oral dosage form, and we continue to try to invest in an ophthalmic state-of-the-art unit to bring it to this market with the high demands that we see there. Basically, when I speak about how we are tackling our revenue growth in the strategic therapy area, and the clusters and regions, this is a slide that really give me the optimal pleasure because this shows that the strategies that we do in our offices, people take it and excel in executing across all markets and all categories. I'm very proud of this slide because when you look at on the left-hand side, category by category, almost every single category we touch on has grown on a very healthy manner between ophthalmology and dermatology and all the categories. None of the categories that I can remember didn't grow, except perhaps one because of mobilization of more business into tenders and retail at a lower price. But away from this, grow tremendously on every category. But on the right-hand side as well, every single market and cluster contributed to our growth. So all of them achieved above 100%, and all of them achieved a huge growth in 2024. You look at Saudi, it's 19% compared to a market that I told you about grew at 11%. In the Gulf, we grow at a very healthy 30%. Iraq, 11%, North Africa, 22%, and Egypt, 19%, which is even, if you take off the devaluation concept, it will be multiples of this 20% growth. Very pleased with this performance, which shows that people are bringing our strategy into action and even excelling in execution better than we expected them to. Next slide. So if I speak about the quarter in hand, again, we listened to you guys in the last few years about the last quarter, and you'll be pleased to see that our last quarter in 24 have done very well compared to the similar quarter in 23. So from a revenue perspective, grew at 24%. From an EBITDA perspective, 33% growth. Free cash converts 36% growth, and then on the net profit front, 16%. But if you really take off some of the very healthy provisions, I would like to say that we have taken in 2024 last quarter, cleaning our books from every provision that we know, anything that was done in the past and it can come and haunt us that we knew about, we have taken. In addition, for the first time, we have taken a provision for the LTI as well for the team. So net, it's almost 10 million provision that we have taken in this last quarter. That would have got us into a growth of close to 30% on the quarter front, and an achievement of close to 23-24% on the net profit margin. Very pleased with this performance of the last quarter, and hopefully we continue to evolve our business and our split quarter by quarter as well. That's an important slide because it dials into how we really look into our future organically. This is our pipeline, and as you can see, it's a very balanced, I must say. I'm pleased with the balance we have there between our different key categories. So between ophthalmology, you can see we have a total of 15 products, and you look at the consumer health, we have 12 products everywhere. And I would like to perhaps bring the spotlight light here on the cardiometabolic, where you see 23 products coming into action over the coming few years between anti-diabetic products, almost 8, 9 on the cardiovascular front, and 6 on the metabolic and gastrointestinal front. Pleased to say that, as I previewed you earlier, we got 10 products approved within 2024 out of this pipeline, and 9 brands were launched. So 10 products approved, 9 launched, and 1 was launched in early 2025. So again, pleased with the speed to action and the progress and the agility of the team in this front. So in this slide, again, we continue to report to you how we are evolving our portfolio and diversifying our business. So while, as I showed you earlier, ophthalmology and dermatology continue to grow on a very healthy manner, their share of the pie is reduced between year 2021 and 2024 from 55% to 47%, while we are definitely growing at a much faster pace when it comes to consumer health, when it comes to general medicine, when it comes to some other key categories as well. So I'm very pleased with this diversification, but I say to the team, would like to see more and more, especially better contribution as well on the anti-diabetic and the cardiometabolic fronts. This is the slide I told you about, whereby you can see into action how we take seriously recruiting and attracting and developing talents and acquiring as well the key talents. This is the slide that shows you the transformation I continue to do on the leadership front, my direct reports. So as you can see here, we have 4 new executives that joined my team in 2025. Very pleased with their joining. As you can see them in orange. Start with Ala Al-Zaka. Ala comes with almost 25 years experience across big names on the multinational and international big pharma like Merck Sharp and Dohme, Novartis, Bayer, Mondipharm, and some others. So Ala joins as our Chief Transformation and Marketing Officer. Haitham Akl. Haitham again come to Jamjoom Pharma with 26 years of wealthy experience between GlaxoSmithKline and Hikma across different parts of the region and across different business sectors as well. He now heads our Saudi Arabian market as a vice president. Then we have Samer Lazaik. Samer comes with 27 years in one organization serving Bayer, but different markets and different businesses. So he has been all over the place with Bayer. Few years in Munich. He's a German Lebanese. A few years in US. Some years in some other places across Europe, and he headed their organization in Egypt, headed their organization in Saudi, and headed their organization in the Gulf as well. So Samer comes as our general manager for Gulf, Levant markets, and other export markets. And last but not least, Ahmed Al-Kholi. Ahmed joins again, similar to Samer, with 20 years experience in one company, Sanofi Aventis. And Ahmed comes as a general manager for cardiometabolic and central nervous system across all markets. And that's an innovative approach we're trying, because one of my early observations on when we started to launch type 2 diabetic product is that the focus and the balance between focusing on detailing and launching and serving chronic medication versus acute, I think we need to do better at as an organization. And perhaps until we build the critical mass into these important categories, namely cardiometabolic and central nervous system, I need someone to harmonize the approach across all our active markets, build the critical mass, and then perhaps in 3-4 years we'll push it back into markets like every other category as well. So that's innovative approach that we'll try, and we'll keep you posted about how we progress in this front as well. Very pleased with joining of this gentleman. As you can see, as well, out of my 12 direct reports, between the 4 new and the people who have been only in the company for a year or year and a half, that's 66% of my, so 2/3 of my team are new to the organization, less than 1 year or between 1 and 1.5 years old, or typically brand new to the organization. And everyone else, with exception of one person, which is my CFO, everyone else has been as well in the job for 2.5, 2 years or 3, up between 2 to 2.5 to 3.5 years. So it's a transformation I spoke to you about. I'm very pleased with how we are progressing in this front, and we'll keep on pushing the envelope until we really get the right team that can serve our business in different business cycles and really optimize our results. With this, I will pass the ground to Pharma Mohideen to highlights.
Thank you, Dr. Tariq, and good afternoon, everyone, and thank you for joining us today for our earnings calls. Already, Dr. Tariq has briefly described you for our overall performance for 2024. I am pleased to share that our performance in the year 2024 has demonstrated continued growth across all financial metrics. Speaking of our cost management, we have effectively navigated rising costs through offsetting cost of revenue increase with operating leverage in other expenses. Our cost of revenue rose by 25% year-on-year, driven by the increase in direct production cost, including raw materials and consumables, as well as employee-related costs. Our raw material expenses increased by 23% year-on-year due to production ramp-ups across all our facilities, while salaries and employee-related costs rose by 33% year-on-year, reflecting the hiring of new talent in our plant, especially to support the business expansion and strategic growth. Depreciation and amortization expenses rose by 57% year-on-year due to the full year impact of our new facility in Egypt and a partial impact from the newly capitalized Jeddah plant. Despite this cost pressure, our effective cost control have helped mitigate their impact. Cost of revenue outpaced revenue due to changes in product and geographic mix. On the other hand, we implemented strict control on operating expenses, which increased by only 9% year-on-year, highlighting our continued focus on efficiency. Our direct production cost per unit remains at 2.8 Saudi Riyal, largely flat compared to last year and comfortably lower than the year 2022. Moving on to the next slide, where we focus on our margins. I am pleased to report that our EBITDA margin expanded to 33.2% in the year 2024, representing a 2 percentage point improvement from our last year and beating our guided target of 31 to 32.5%. This improvement was achieved despite rising costs, thanks to operational efficiencies, improved sales efforts, and contribution from our Algerian joint venture. As shown on the right side of this slide, our EBITDA and net profit margins have decreased slightly in Q4 2024. This decline was due to strategically lower sales in Q4 2024, plus some one-time provisions, which Dr. Tariq already explained. However, we remain a leading player in industry in terms of profitability. Moving to the next slide, we will move to the cash conversion cycle. Lastly, our focus on cash flow efficiency continues to support our strategic growth. Our cash conversion cycle increased slightly by 8.5% to 252 days, reflecting our strategy to build inventory reserves and manage our receivables and payables due to business expansion. Working capital grew by 28% year-on-year to Saudi Riyal 594 million, reflecting a strategic inventory build up in order to support anticipated future demand. 2024 ended with the net cash balance of Saudi Riyal 262 million, reflecting the solid liquidity position of the company. This performance highlights our ability to sustain the strength of our core operations and generate liquidity by balancing growth with financial prudence. Following dividend distribution to shareholders in June and August 2024, which align with our strategy to deliver tangible shareholder value. With this, I would like to hand over to Dr. Tariq for future outlook.
Thank you, Anwar. So the last slide is as you guys are used with us now. So we'll give you the reaffirmation for our 25 to 27 guidance at the last column. So basically, from a revenue perspective, we continue to reaffirm the 12 to 15% growth year on year. On the EBITDA front, we reaffirmed the 30% with a potential of 100 to 150 extra point growth. On CapEx, 4 to 6%. And on the dividend, we remain committed for the 50 to 60% payout ratio on biannual basis. I will perhaps stop here and invite from the state.
All right, thank you, panelists. Ladies and gentlemen, we will now commence with the Q&A session. You may raise your hand by pressing the hand icon on your screen to speak with the panelists, or alternatively, you may drop your question onto the Q&A chat box. With that being said, please limit your questions to 2 at a time so we may satisfy as many questions from participants as possible. You are, however, more than welcome to join the back of the queue if you have a follow-up. So without further ado, the Q&A session is now open. All right, we have a question from the Q&A box. Jane is asking, why were sales strategically lower in Q4?
Why were sales
strategically lower in Q4?
Strategically, that's yeah. So basically, we repeatedly explained this. On the shipment, we have 2 sales going in parallel, the in-market and the 2 market. So let me, maybe I will answer Jen better by a slide, whereby you can see here that, like, for example, this is our Q4 on the 2 market front in orange, almost. I don't know how the color comes to you guys, but either orange or red. And then in purple, you see our in-market sales. So while you can see that on the 2 market front, we closed the quarter with 260 million. On the in-market front, it's above 305 million. So in-market is our sales from our distributor into the market. That's really translating demand into action and responding to street pharmacies, hospitals, and other accounts requiring our products. The 2 market, however, is just shipment from us into our distributors to replenish their stocks and ensure they are ready with dispensing our medications when they receive the orders. So while we slow down on the last quarter, because we really pumped the first 9 months a slight high on the distributor front, the in-market never stops and continue to perform consistently across every month. So this is the strategies that we adapted since 2022, been very successful with us, and I have zero intent to improve it. But I listened to some comments last year when people told us that perhaps it's very the last quarter relatively to other quarters seems pretty much on the high side. So this year we try to make the balance a little bit, and we improved, as you can see, our Q4. So listening to you guys and learning sometimes from you how we can perhaps run our business in a more balanced manner. But it's definitely a strategy that is working well, serving our business, but more importantly, serving our customers as well, be it the street customers or the patients and consumer, but as well our distributors who are a key customer. We don't bombard them in the last quarter with a lot of sales and a lot of deals at the start of the following year, but they start the new year hitting the ground running and ready to really replenish their stocks and buying healthy stocks from us. So that's a strategy that, as I said, have been working for us and continue to work well for us. Thank you, Jen, for the question.
That's very clear. Thank you, Dr. Tariq. Our next question comes from the line of Sultan. Sultan, your line is now open. Please unmute yourself and go ahead.
Hi, Mr. Tariq. First of all, congrats for the strong set of results. Can you hear me, guys?
We can.
Yeah.
Yes.
So I only have two questions. One, in your guidance, you're assuming 30 to 31.5% EBITDA margin, which is lower, like 150 basis points lower than your 2024 EBITDA margin. Are you assuming? Are you being conservative here, or just you're assuming generally margins will decline?
Is that your question, Sultan?
Yes, this is the first question.
Okay. You want to ask the second one, and then I can.
Yeah, sure. And again, similarly, in your guidance, are you taking into account the new launches for the revenue growth guidance you're giving from like 12 to 15? Are you considering the new launches, or is that not reflected in the growth guidance?
Yeah. Thank you, Sultan, for the couple of interlinked questions. So first, on the EBITDA front, we definitely are not being more conservative or sandbagging, but I think since we went public in June 2023, people who have been with us since then, I think, are used to us promising and delivering, but we don't under-promise and or over-promise. Once we know things concrete in our hands, we basically come back and upgrade or change our guidance. But as we stand today, we believe that we are embarking on a year with different dynamics in the marketplace. The numbers that we can stand solid to is the numbers that we are sharing with you here. Come end of quarter two, quarter three, if we see that things are working better in terms of market uptake, and as well we see that it's not a one-off improvement, but the market will continue to do well until the end of the year. It will not be the first time that we'll come and say we'll upgrade our top line and bottom line into different figures. But we always start with this numbers that we, based on our SARA budgeting and forecasting exercise, we can stand solid too. And then we'll continue to upgrade you as the year evolves.
Just a follow-up, Mr. Tariq, if you allow me. Can you walk us through why you think the margins will decline? Is it like more of the Jeddah facility? I mean, the new Egypt facility. Do you think the product mix will shift towards like lower market, which might have like lower margins, or is it the NOPCO exposure? Can you like add more color if you can, please?
No, it's none of the above. It's so listen. I mean, when you continue to outperform the market for 3 years in a row, and you do 20%, you don't come the following year if you don't have real solid new things in your mind, and you are forecasting the market overall in the region to grow at an 8 to 10%, and then you come and promise another beyond the 15 or 18%. So that's our position, Akhi Sultan. The fact is that we grow year on year on 19-20% for the last 3 years. I don't think it make me stand solid here and come and tell you, unless I have some inorganic opportunity or other out of calculation opportunity in my hand. But what we do every year, so that I don't take you into unnecessary details, during our budgeting and forecasting exercise that we take almost between 4 to 5 weeks in finalizing it, and we take it very seriously. We start with the external markets, how we forecast the market to grow, how we forecast our internal opportunities to grow, including but not limited to, as you mentioned, the new products and everything else that we have in hand. And then we come up with our set of figures. Basically, we start the year like this. If the if the year surprise us pleasantly as it did in the last 3 years, we'll come and let you guys know by the second or third quarter. God forbid, if it happened the other way, either we'll find other ways to compensate from pushing other markets or other products or whatever, or we'll come and tell you in full transparency, the market is behaving at much less than what we forecasted for it. That's why we believe that our own forecast as well will come down. We haven't reached this yet, and hopefully we don't. But one of the reasons why is that we always start with the solid, confirmed numbers in our hands with you, and then we'll update you as the year goes. And we would like to continue to do this in full transparent manner.
Very clear. Thank you, Mr. Tariq.
Sure.
Thank you for that. Our next question comes from the line of Yash. Yash, your line is unmuted. Please unmute yourself and go ahead.
Thank you, Al Jazeera Capital, for hosting the call. I have two questions. So first, how do you view the size of the tender business market opportunity in the short and the medium term? And what share do you expect to capture? This is
sorry, you're breaking up. I can hardly hear you. So either you come close to the microphone, or because you're breaking up, I cannot hear you properly.
Hello, am I audible?
A little bit better, yes. Carry on.
So I have two set of questions. The first is, how do you view the size of tender business market opportunity in the short and the medium term? And what share do you expect to capture? This is my first question. And my second question is, what are some expiring patents that the sector is racing towards that we should be looking at? If you could throw some light on this.
So the first question, yeah, we continue, as we always mentioned to you guys, to target doing better in the institution and tender business. But we do this, as I said, cautiously and consciously, driving both top and bottom line, not just selling commodity or diluting our margins. So we become very selective in the products that we target the tender market with. And we continue the dialogue with authorities and regulators and people who are responsible for this business to explain to us and show us the unmet needs and the windows that we can come and satisfy with our products, with a unique business proposition without impacting, pretty much reducing prices and diluting margins. So that's what we continue to do. So to become more concrete, because you guys like numbers, Saudi Arabia, for example, which is our key tender and institution market, it's almost contributing into 90% of our tender across all active markets. In Saudi, we basically concluded 2024 with 20% business representation of the institution and tender compared to the total business. We continue to evolve this business, and hopefully we will push for the likes of 25 to 30% out of the total Saudi business coming from institution and tender. But as I said, in a selective manner and with the best products proposition and product mix that enable us to really compete selectively and assertively in this market without diluting margins. So that's basically what we look at. Your second part of the question, which is patent expiries and are we looking into other areas? I think I tried to allude into the fact in my presentation that one of the areas that it's really getting more and more competitive, but as well needed in the market is the balance of the biosimilars and biologicals products. So we're looking into this area very seriously. And when it comes to biosimilars, as you know, it's already off-patent product. So you're playing in an arena where you bring It's exactly the translation, the literal translation of the name. It's similar to the biologicals, but off patent, and but you can bring some unique proposition products in this arena where no one else is serving some unique disease areas, and then you can win in this market front. Others, and I'm sure you have it in your mind while asking this question, is things like on the weight loss front. Weight loss / diabetic treatments. And yeah, definitely we continue to push the envelope and look for some products that either it's close to lose patent or innovative way of looking at how can we really look at similar products that doesn't come under the patency protection but provide similar end result to and benefits to the patients like weight loss and type 2 diabetes control. So we continue to push this envelope as well, and we're looking at both areas plus other areas. But once something is concrete in our hands, we'll come and let you know. And perhaps to link your question with Sultan's question, if some of these opportunities become meaningful and we can finalize it in 2025, definitely this will contribute in a lucrative and surplus way into our top line and bottom line guidance. Thank you for the question.
Thank you, Dr. Tariq. We have a question from the line of Taha. Taha, your line is unmuted. Please unmute yourself and go ahead.
By the management as always. So a couple of questions from my side. One needed clarity on the Jeddah facility. You showed that it's like the capacity and production is now nearly like near full utilization. So like, will you be needing capex on this facility, and how will, or is it expandable above utilization to serve the obviously the double-digit revenue growth for 2025 to 2027 period? And the second question is, how do you see the industry growth in 2024? Obviously, 24 was a good year. Thanks to the diabetic obviously product, but how do you see overall the market industry growth in 25? Thank you.
Sure, Tom. Listen, you can only be as sure as you can when it comes to things like capacity, because you know, I mean, it's a final product of many things. One of it that you can never undermine is leadership continue to push the envelope and seeking and pushing people to ways of improving the capacity with minimal capex investment, which is perhaps what you are alluding to in your question. Yeah, but listen, yeah, I mean, we know that we have been working hand to mouth over the last couple of years and in this facility, and I transparently share this with you guys regularly. Would we need capex to upgrade? Of course. I mean, this is a capacity, as you know, it's up and running since year 2000, 2001. But is it part that will come over and above the 4-6% guidance that we spoke to on the guidance front of the capex? No, it's within the 4 to 6%. Whatever upgrades or new machinery we need, both for this facility and any other facility for that matter. So it's always taken into account.
Great. And the industry growth, how do you see that panning out 25?
Yeah, I mentioned it already. I think I told you that our forecast this year is an average of 8 to 10% across our active markets. Hence our guidance of 12 to 15% to beat the market again. So we'll see whether the market will stay at 8 to 10, will come lower or come higher. We'll see. I mean, you know, the last couple of years were a little bit skewed with some unusual products that came into the market, namely the weight loss products that contributed in some times into almost 30 plus or 40 plus % out of the total growth of some of the key markets. So when you take this, when these products start to become normalized in this year and beyond, and you see the real growth of the market, we'll see how would that look like. Our forecast is, as I showed you, and our forecast, by the way, we don't base it on intuitions or our best guess, but we look as well at some of our consultancies and market research guys who basically publish the reports, and basically we take some mix and match of some of these reports, and then we come up with a realistic expectation for the external markets, and then we set our own internal expectations. So this is how we do it without bombarding you with details.
Great. Thank you so much.
You're welcome. Thank you for the question.
All right, thank you for that. We do have some questions piling up in the Q&A box, so I'll read some of those off. So we have a question from Rabih. Rabih, he thanks you for the call, and then he asks, how much can we expect in percentage terms for capacity increases per quarter to reach 70% for the Egypt facility?
Per quarter?
Per quarter.
Yeah, I mean, it's difficult because I wish it works this way. It doesn't always become even, quite honestly. But yeah, basically, as I told you, we closed last year almost was 50%, and we are targeting 70% at the end of this year. So it's almost a 20% addition. So yeah, I can take an easy approach and tell you it will be a 7% increase quarter on quarter, or 6%. But in full frankness and transparency, it doesn't work this way. It's much more complicated than this. It depends on the product mix. It depends on our readiness with material, because for a machine to work, you need materials, you need active ingredients, you need excipients, you need this and that. You need everything to be ready at the right time for your machines to evolve and produce. And you take as well some other seasonalities of the market into account, and so it doesn't really work. We don't do it quarter by quarter, but we do it across the year, and we say this is the volume we target. What percentage of the total volume that is required for Egypt is going to be produced locally, and how would that represent out of the total capacity of the local facility? So this is how we come into the number I shared with you.
That's very clear. Thank you.
You're
Well,
welcome.
another question from the Q&A box. We've got a question from Sarah. Sarah's asking if you could please shed some light on the performance of the Algerian joint venture, if you have any guidance on that front.
Yeah, absolutely. Yeah, just thank you, Sarah. I just came from Algeria overnight, so it's like fresh in my mind. And yeah, I'm very pleased with how we are evolving in this not easy market, perhaps but very, very rewarding if you get your act together and do things right in this market. So luckily for us, I think we have really started on the right foot and we're getting a lot of internal support as well. People are really appreciating that Jamjoom Pharma is willing to invest in this key market. Authorities are appreciating this, especially on the things like ophthalmology and some other key products that we have. They are pushing us to bring even the facility that will produce ophthalmic products sooner than later because of the greater need in the marketplace. Yeah, so we're really, and we have a very good active partner there who has 51%, as you know, as per the local law. People who have expertise in the marketplace, and that was definitely the target in my mind when we embarked on starting our business there and investing there in Algeria, because I wanted really a strong partner, not just financially, but someone who can help us and becomes our eye on the ground to help us with key decision making. Because I mean, we don't have our troops condensed there as much as they are in Saudi or in the Gulf or whatever. And we're pleased with the partner there. We're pleased with the support we are getting. We're pleased with how we are progressing in terms of getting approvals for the new ophthalmic unit, for some exceptions that will enable us to bring some of our key products until we finalize our construction. So in general, it's progressing positively. I'm glad to report to you as well, Sarah. Yes, last year was our first full year operating in Algeria. We concluded the deal in September, October 2023. So 24 was our first full financial year, and we closed the year exceeding expectation from a top and the bottom line front. Mind you, as a refresher, we don't consolidate our top line there because of the 51%. But we share the profit with our partner. And yeah, until this regulation change, we are pleased with this arrangements, because it's really either this or you become out of this very important market for North Africa, and we choose not to. Until perhaps one day regulation will change and we can even consolidate our top line, we're pleased with the way things are evolving in Algeria. But thank you for the question.
That's very clear. Thank you very much. Panelists, I just wanted to ask, as we've run over the allotted time, is it all right with you if we run over time till we ask some of the questions, as we still got some questions piled up?
I'm good to go on until the people are fed up with me. But yeah.
All right, great. Thank you very much. So I'll read one more question off the Q&A box from Muhammad. Muhammad asks, how many products out of your pipeline are expected to be launched in 2025?
Yeah, as I said, as a guidance, Muhammad, as I always said for the last couple of years, and I reaffirm now, it's between 6 and 10. Last year we targeted this and we ended up launching 9, as you have seen. This year will not be different. We'll target this. That's, mind you, Muhammad, because I know this is perhaps one of the reasons of your question. This is organic, this is internal, out of the pipeline I showed you. Now, if we manage to finalize some of the deals, that it's work in progress for us at the moment, as I shared with you guys, yeah, this will be over and above. But what we can guarantee for you today that we'll target internally, organically, is the 6 to 10 that we continue to target year on year. Thank you, Mohammed, for the question.
Very clear. Thank you. Going back to the raised hands, we've got a question from the line of Ibrahim Atiyah. Ibrahim, your line is unmuted. Please unmute yourself and go ahead. Oh, it seems, oh, there he is.
Yeah, from Ashmore Investment. First of all, congrats on the strong set of results. I do have a few questions. One on NOPCO tender, which is the new tender that started in H2. So can you tell us how it's progressing towards the Q4?
Sorry, Ibrahim. I understand you're asking about NOPCO tender. I understand you are asking about the new tender that was awarded in 24 for the coming 2 years. But then I didn't hear your last part of the question. What are you focusing on?
How is it progressing towards Q4?
Q4 2024?
Yes.
It's progressing well. I mean, the previous tender was supposed to carry on for up to 2022, and then it was extended for another year to 2023. And then we had a new tender in 24 that we started working on this new tender awardation and the delivery as late as September, October. And yeah, in Q4, we did some deliveries, and as well this quarter in Q1 2025, we are doing some increasing deliveries as well of this tender. So in general, it's working well for us. And the way this works, so that everyone around the call understand, we get awardation, we get like first award, and we get some possibilities as well from some other products that we get it as a second award. So if the first awardee failed to deliver or has any problems, then we jump into the becoming first awardee, and so keep an eye on this. But as well, whatever you get as a first awardee, you can increase depends on your people as well, liquidating into the accounts and the hospital, and then they can give you like an extension in the tender of the tender over the couple of years. So it's work in progress. It's never as people sometimes imagine it's a one-off every 2 years. No. Yeah, it's the big bulk is one-off, but then you have as well some additional awardation, smaller quantities compared to the original one. But yeah, it continued to evolve over 2 years. So we're pleased with what we got in 2024, and we keep on pushing the envelope to increase on some of the strategic products as well in terms of creating demand and hopefully getting more orders.
Excellent. So let me be specific. Is there any delays on deliveries versus the purchase orders by NUPCO?
Well, I mean, there's always, I mean, sometimes we deliver early, sometimes we have some delays. Yeah, I mean, that's the nature of the beast. It depends as well, because that's sometimes they want products earlier than we can produce and purchase materials and everything. But critical delays that make me lose sleep overnight, the answer is no. But yeah, there's always some wash between early to late delays and everything in between. How can we? But we keep the communication with them, and when we have some delays for a legitimate, clear reason, we communicate to them and we say, listen, guys, I mean, we might be late by so and so. Maybe we can have partial delivery, and then we'll get the rest later on. And yeah, if your question is about do we sometimes get some perhaps alerts from them that we are a little bit delayed more in some products, it happens with every company, and us no exception as well. But in general, I think we keep on evolving well in terms of our sticking to delivery on time and matching the requirements.
Excellent. This is very helpful. Just a follow-up question on the same subject is, what was the exact growth in the public market during 2024? If there is any available figure.
I mentioned it in one of the slides, 26%. So it was there on the perhaps.
Sorry, not for Jamjoom market.
Yes. No, it's difficult. It's difficult. It's very difficult for the total market. You cannot get, and even when you get it, Mohammed. So let me share with you, for example, if the market has. And actually, that's the case. The tender market has a lot of categories that you are not a player at, and these are significant categories. They play like for big part, like for example, vaccines. You are not at the moment as we stand. The Jamjoom Pharma is not a player. Biological biosimilar is not a player. So even if you can get access to the concrete overall growth on the tender, which we don't get. Even if you get it, how you are going to dissect between the categories where you play and you have active representation, and the other big categories that constitute big part of the market, and you don't play at. So it's difficult to compare. It will not be apple to apple.
Fair enough. My second question is on the slide of in market and to market.
Yeah.
And I'm not sure if this is an illustration or it's actual numbers, but I can see that in market sales. It's actual numbers. Excellent. So the in-market sales only grew by 4% year on year. I mean, based on the slide I have from last year presentation, so which showed only 4% growth in the in-market. So can you help us understand the variance that happened during this quarter?
No, but yeah, the variance. Yeah, I mean, I keep on trying to explain the variance. So basically, hopefully, and you guys keep the feedback going, because I failed a little bit partially to convey the message sometimes to certain people. Basically, what you do, what we try to do, Mohammed, is in the first 9 months of the year, we ensure that we replenish and we stock our distributors in a very healthy manner to meet/exceed our forecasted numbers for the full year. Okay, in the first 9 months, and then we come in August/September time, and we say, okay, now given our in-market forecast for the coming 3 to 4 months to finish the year, as well as what we need to start the year after with strategic stocks. What further stocks do we need to sell in the fourth quarter? And then we do this. So as I said, while the in-market go across the year consistently, and we never play like a huge push in the first 9 months and then a little bit slow down in the last quarter, we do this on the two market so that we can balance things and we can start the year on a very healthy front, both with stock level as well as distributor debts and commitment to us in terms of payments. So that's what we try to do.
So you do see 4% growth in end market as sustainable going into next year, or I misunderstood your point. Yeah, 4% growth in end market.
So you're talking between last year and this year's slides?
Yeah, end market, yes.
Yeah, I mean, or more, quite honestly, because you asked a very good question. Initially, you started your discussion with the question on the institution deliveries in fourth quarter, for example. If next year, if 25, we have more deliveries in the last quarter, and we created more demand on the institutional front, that will increase our sales, in-market sales growth over the last quarter of 24. And the same in retail. And the same if we bring some products in organically. So all this will contribute. It's not, I wish I can give you a simple answer, Mohammed, but it's never a simple answer. All this will contribute into, but what I can guarantee you, you will see a healthy growth. That's the only thing I can guarantee. What percentage? I cannot tell you as we speak.
Excellent, great. Thank you so much. And this is very helpful, and wish you all the best.
Thank you for your question. Thank you very much.
Thank you very much. We do have a question from the line of Abdulaziz. Abdulaziz, your line is now open. Please unmute yourself and go ahead.
For the presentation. This is Abdulaziz Al-Sheikh from Jamjoom Investment. So my first question is on the margins and therapeutic areas. We noticed, mashallah, this quarter, the company have achieved 61% gross margin. And we also noticed that ophthalmology and consumer health have led the growth in the fourth quarter. Did the higher growth in these categories impact the margin, as in those categories have somewhat higher margins? And my second question is on the regulatory prices versus freely priced products. Is there part of the company's portfolio that is freely priced, not regulated under the SFDA? And if there is any, what's the contribution and in which therapeutic areas? Thank you, gentlemen.
No, thank you, Abdulaziz, for the question. Listen, Abdulaziz, you're not helping me. Don't spoil my finance guys by saying to them that the gross margin at 61% is good. I keep on pushing them to say it's not good enough. We need to increase it. But yeah, we always target something between 62 to 65, or even hopefully above. Hopefully this year you will see an improvement in this front as the year evolves with us. So your first question was about the basically.
So basically, on the therapeutic areas, is there
on the therapeutic areas, OFSA and Derma contributed, and yes, you're spot on. Not only ophthalmology and dermatology, but so in general, Aziz, and that's I'm glad you are paving the way for me. But perhaps that's the only thing I didn't mention during the call, which is when we did the strategy refresh with the team. One of the things that we really pushed for 2025 and beyond is how we look more into selling more and more smarter and focusing on strategic / high margin products that becomes a bigger portion of our sales as we move on. And majority of our investment goes behind these products. So it's basically putting our money where our mouth is. So this will continue to evolve, and we'll keep on doing this. What you have seen in Q4, I'm hoping that will continue. You will continue to see quarter in, quarter out as we move. If the strategy that we have refreshed is going to be successful and will work well for us, and I wish it will, inshallah. I have all the reason to believe that it will. So that's the first question you asked. The second is related to which part of our business is free priced. And yes, the consumer health in many products of it are free priced. It's mainly, as you remember, perhaps Abdulaziz and others, it's mainly dominating in terms of business contribution in the Saudi market. We launched it ourselves with some modest consumer health products in the Gulf area, in Iraq as well. And we're looking at other markets to even expand this very successful category for us that give us a very meaningful competitive advantage in the market. We're looking forward as well to launch this category this year into more markets. As well, we keep on complementing this category with new areas like probiotics. So last year, we launched almost 3-4 probiotics under our consumer health categories, and we'll continue to do this as we move on. So many products under the consumer health are free priced, but we play it as well reasonably, and we study the consumer expectation and the average prices in the market and the rebates that we need to pay in the market. So it's as complicated as our pharma business when it comes to, but it's a different way and different channels of selling it as well. But very, very interesting portfolio that I'm very pleased about how we are progressing there. And we haven't even scratched the surface because we are just focusing in Saudi. Imagine when you repeat the success we had in Saudi in all our active markets, definitely this consumer health will give us a very good competitive edge as we move on.
Great. Just to follow up here, Dr. Tariq. So these free priced products, do they generally have higher margins, and what percentage of the portfolio is freely priced?
So the consumer health in general, basically give or take, Muhammad, is you're talking about almost give or take, you're talking about basically something within the range of 20%, give or take, of your sales is within the consumer health category. But that's, as I said, only in Saudi Arabia. And hopefully we move by launching it into other markets. And we focus on high profit products as well. I know that you repeated the question a couple of times. And basically, I think you're trying to hint that it might be a different or lower margin than the typical pharma. And the answer is yes in some products, but no in some other products as well. In general, we are pleased with the consumer health contribution top line, and the bottom line remain very competitive with the typical players in the marketplace. And I mean, it's a way of how you diversify your portfolio as well, Abdulaziz, and provide a unique competitive advantage that wrong foods your competition as well. So for us, it's strategically viable and vital for us to continue, even though it might be slightly less margin than the typical pharma.
Great. Thanks a lot, Dr. Tariq.
Anytime. Thank you very much.
Thank you for that. We'll be moving on to the Q&A chat box as we still do have a couple of questions from there. We've got 2 questions from Abdulaziz. Abdulaziz wants to know if you could please clarify why your DSO is better than the industry average. His second question asks, is the industry facing some issues regarding...
Can you repeat the first question?
Sure. So Abdulaziz is asking, could you please clarify why your days of sales outstanding is better than the industry average?
Yes. Okay.
And his second question asks if the industry is facing some issues regarding sourcing APIs locally, and is that affecting localization initiatives?
Industry facing some issues regarding sourcing APIs.
APIs locally. Yes.
Yes. Which can affect localization initiative. Yeah, good 2 questions, Abdulaziz. So the first question, I'll have an attempt, and I will pass the floor to my CFO Anwar to carry on. Basically, when you look at our key competitors, Abdulaziz, when it comes to DSOs, they run their own distribution, which can be a good blessing or a curse as well, because when you run your own distribution, which is something we avoided to have, you become a little bit more complacent, and you become the judge and jury at the same time, which is something that we try to stay out. Our main focus of the business is to drive sales and drive marketing and drive stuff, and we have the experts who help us in terms of distribution. So that's why we keep on pushing the envelope better, and we don't have similar complacency to what you see perhaps in the marketplace. I don't know, Anwar, if you have any addition.
Dr. Tariq, you already explained that, okay, yes, some of our competitors have their own distribution, where they are facing some challenges in the local market, whereas that we are, in case say we are distributing through the distributor. Plus, one more point I would like to add, our exports, I mean, almost 35%, more than 35% sales are our exports. And in our exports, we are covered by SBLCs, LCs. So these payments is, we are not getting any delays from our receivable from our exports. So that is also improving our, days on receivables. So that is the two reasons that, okay, in local market, we are distributing through distributed, not our own distribution. And international, that, okay, we are covered through LCs and SBLCs.
Thank you, Anwar. And for your second question, Abdulaziz, which is basically related to the API sourcing and other sourcing. We faced some challenges in 24, Red Sea crisis and other stuff, but is it to the extent of impacting localization? And I wouldn't say so. I hope the issue do not get more dramatized or have more negative impact on us in 24. But we always have our plan B. I think I briefed you in 24 in an earlier quarter that we strategically forecasted from the beginning of the year to order more of our strategic API materials than perhaps our norm. And the little we knew about the Red Sea crisis, we only wanted to do it to control the controllables and to ensure that we have enough stocks if increased demand happened. But it worked for us nicely and helped us as a competitive advantage compared to others. And we'll continue to do this, quite honestly, trying to push the envelope and ordering more of the strategic APIs requirements so that we can really ensure that we are in control of our destiny, as they will say, but more importantly, diversifying as well our sourcing. Not necessarily number, but as well sometimes country and quality. So we don't have to rely on like 3 or 4 distributors for the same material from the same country, but hopefully 2 or 3 distributors but different countries, so that if you have a problem in one route, hopefully the other doesn't. So we try to continue to do this as we move on, and this is how we try to manage and minimize the risk on us. Thank you for the 2 questions, Abdulaziz.
That's very clear. Thank you, panelists. Another question from the Q&A box. We've got Haifa Al-Abdulhadi asking 2 questions. She wants to know, how much is the contribution of the newly launched 9 products? Her second question asks, who bears the risk of expired products? Does the agreement work between you and the distributor? How does the agreement work between you and the distributor regarding expired products?
Yeah, so basically, is it Haifa? Yeah. So Haifa, basically, we normally target, unless it's really a different, unique product proposition, we normally target in the first year of launch, and it depends on timing and this as well, between 1 to 3% contribution of new products to our overall portfolio. In 2024, to be exact, it came close to 1.5%, which is, again, it's impacted by sometimes you launch later than expected and this and that, but it's within our target, and in an absolute number or value of new product launches, we exceeded our budget for 2024 when it comes to new products. But we generally target 1 to 3% in any given year of new product contribution, unless, as I told you, if it's really a unique product proposition that's coming, hitting the ground running, which will be a different ball game completely. I look forward to having this kind of products as we move on in our inorganic product portfolio shopping. Basically, your second question is about expiries with distributors, which is very technical. Yeah, it differs from one distributor and one country to another, but in all absolute fairness, it's our product at the end of the day. Distributor is just a middleman. They don't do promotion. They don't do push of the product. They just respond to demands from the market. So if, for example, we push products on them on the premises that it will be sold and we fail to sell it, it's our problem, it's our mistake, it's our baby, we have to take it back. So in majority of the cases, we play fair and just, and we say, definitely, we control the controllable initially by not pushing more product that our people can sell, or that can come back and haunt us lately as expiries. But as well, when it happens, we take the product back. But we keep it, if your question is more specific about our average, we keep it within the industry average, which doesn't exceed, hopefully, the 2 to 3% on annual basis. And and we keep on pushing the envelope and even bringing it down.
And let me add that, okay, we already have a provision from the sales for this 2 to 3%.
Yeah, but even though we don't become complacent, Anwar, with just because of the provision, but we push the envelope. The less we do, the better, because it doesn't only impact the money, because we secure ourselves, to Anwar's point, by provision, but as well, we don't want our credibility to be impacted. Forecasting accuracy is very important for us, and we take it diligently. We don't push products on partners that we don't think that we can sell, or it will come back and haunt us. So it's very important for us that we play it this way. Other questions?
Thank you for that. We do have a follow-up from the mic section. We've got a follow-up from Ibrahim Atiyah. Ibrahim, your line, there he is. Ibrahim, your line is open. Please unmute yourself and go ahead. Seems he dropped out of the line. We do have a follow-up from Abdulaziz. Abdulaziz, if you don't have a follow-up, please lower your hand. Otherwise, I will unmute you. Abdulaziz dropped out as well. And Sultan, if you do not have a follow-up, could you please lower your hand? Otherwise, I will unmute you, and your line is now open. Please unmute yourself and go ahead.
Thank you, Ibrahim. Hi, Mr. Tariq again. So I just have two very quick questions. You mentioned you had one-off in the fourth quarter of around 10 million, right?
Correct.
And the other question is related to the new Jeddah facility. Can you just give us an update on the ramp-up of that facility?
Update on the Jeddah?
The ramp-up of the utilization, the capacity ramp-up, going into 25.
Yeah, as I said, Abdulaziz, we almost concluded 24 with almost 10% utilization. If you take 10-15%, if you take the 3.5 million produced compared to 23 million theoretical capacity on this facility. Hopefully, this year we can ramp it up to something close to 30-40%, and we keep on evolving on this, because to your best awareness and others, we intend, at least in the first few years, not to shut down our Stride product facility in the existing facility as well, on the old Jeddah facility. So the two will continue to work in parallel. So that's very important for you to understand when you analyze the capacity utilization on this plant as well. So this plant is meant to really help us with the future demand maximization. And we believe, and perhaps that's part of your question, we believe that this plant will keep us going with the growth we expect in the business over the coming 3 years, up to 2027, which means realistically will reach almost 80-90% capacity utilization by 27, and then we'll have to really either upgrade machinery or come up with a new extension or whatever, which we are working on from today to satisfy growth over and beyond 2027.
Yeah, and just another follow-up on my previous question on the EBITDA guidance. like during your talk with Abdulaziz, you mentioned that you're pushing gross margin higher. You want to increase gross margin and you expect gross margin to improve in 25. If gross margin is improving in 25, why are you assuming EBITDA margin is going to decline? Are you assuming?
Gross margin can improve, gross margin can improve, but your investment can improve as well because you're launching new products and you're pushing on many other fronts. So it's not EBITDA is not a final product of just gross margin, as you know better than me. So yeah, we push every line in the P&L, as I said, to become more positive. But as well, we don't become short on investing behind new product launches, behind key strategic products for us, and so that we can drive the growth in a healthy manner. So it's a full equation. It's not you cannot take it in part. Yes, we keep on pushing gross margin, but as well we do this to be able to fund better investments, to fund the better servicing behind products, to ensure that we even fuel our future growth in a more healthy manner.
Thank you, panelists.
Sure.
We have a question from Naif. Naif, please try to limit your questions 2 at a time so we may wrap up all the questions as much as possible. Your line is now open. Please unmute yourself and go ahead.
Hello, am I audible now?
Yes, you are.
Yeah, thank you, Ibrahim, and thank you, management, for your presentation. I just have a clarifying question on the provisions that have been taken. I saw in the presentation that the management said it was 5.1 million in legacy investments, if I'm not mistaken. But now they are saying it was 10 million in the fourth quarter. So which is it, the 10 or the 5?
No, I mentioned already, Ibrahim, because one of it is not, you cannot argue it's a one-off because it will be a repeated year. Because this is the first year we approved an LTI for the team. So we took a provision for this, and we have the provision, which is, you read it rightly, the 5.1 or 5.2, which is a couple of earlier investment that didn't work well for the company, and we decided to clean our books. So when you add the two together, it's close to the 10 million I told you about.
Okay, now it's clear. Yeah, that's all for me. Thank you.
Thank you, panelists. We have a final question from Sarah. Sarah's asking, we noticed Egypt sales declining this quarter as well as the previous quarter. What's the reason behind this decline?
Sarah, sorry, I didn't get the question. Egypt sales decline in Q4?
Yeah, for 2 quarters in a row. And she's asking if you can shed some light on the reason behind that.
Yeah, so as I mentioned earlier, Sarah, we achieved above our target in Egypt, and we achieved a very healthy growth as well. I think the numbers you see as well is a final product of supply and our ability to supply and our ability to rationalize as well, mobilizing volumes from Jeddah or not mobilizing volumes from Jeddah and prioritizing other markets. But the in-market in Egypt went very healthy, and we achieved our number for 2024 above 100% on the target, or on the buck 100% with the growth, as I mentioned in an earlier slide, of 19%. If you take off the devaluation impact, it will be multiples of this 19%. So in general, yeah, I mean, it was a fluctuation of quarter to quarter. So the first 2 quarters in Egypt were hugely above budget, and the second, the latter part of the year that were impacted by supply issues, some product mobilization, some lack of raw materials, and other stuff. It caused this, but net, we managed to make our numbers in Egypt at the end of 2024. Thank you for the observation, sir.
That's very clear. Thank you. And that would have to mark the final question for our session to conclude the call. And on behalf of Al Jazeera Capital, I'd like to extend our sincere thank you to Jamjoom Pharma's management for their time and the presentation, and for your willingness to go overtime on this call. And thank you to our guests for taking the time to join the call as well. Panelists, I'll leave the floor to you for any closing remarks.
No, thank you very much. I really enjoy the company of this group of analysts and investors and business partners. And I like the quality of the questions that are improving one quarter on the other. And guys, you are part of this success. I'm very pleased with you keeping on giving us. We are not only giving you guidance, but you give us sometimes guidance, and we listen and we implement, as I showed you in our last quarter in 24. And we'll continue to keep this healthy dialogue going. Thank you very much, and I wish you an amazing day. Assalamu alaikum.
Wa alaikum salam. Thank you once again, panelists. Thank you to our guests. The meeting is now over.
Thank you so much.
You may close the chat. Thank you. Bye-bye.